Welcome to my how-to series specifically geared towards mortgage processors. In this series, I will be walking you through how to read and understand all different types of documentation required for the financing process, from title work, insurance forms, appraisals, and many more. My name is Gina Warraby, owner and operator of Innovative Edge Processing, and today we will be going through how to read all different types of insurance documentation and even show you a few examples. There are many different types of insurance documentation that can be provided to a mortgage processor throughout the financing process. Some examples are insurance binders, insurance declaration pages, evidence of property insurance, also known as an EOI, and master certificates. These are just some of what you'll need to know how to review. Here is an example of an insurance binder. This is a very common document you will see. This is typical when processing a purchase of a new home, and this shows the lender that the borrower has gone to the insurance agency and applied for an insurance policy. A binder is normally good for 30 to 90 days, and the policy will not actually be effective until the date of the closing. This is one reason why when you request a binder from an agent or an insurance company, they really try to get you to pinpoint the date of closing as soon as possible. It's much easier to move the effective date of the policy forwards instead of backwards, because in most cases when you try to do it backwards, they would have to cancel the policy and start a new one with a new date. Here are samples of an evidence of a property insurance form, or an EOI. As you can see, they are a little bit different than an insurance binder. This form is usually provided to show the lender that the property is in fact insured. It answers all common questions such as what is the dwelling coverage, the premium amount, and if the property is clear and free or has a mortgage on it. Here's an example of a declaration page. The main purpose of this type of document is to provide a summary of the policy that is currently in effect. It is very similar to an evidence of insurance or an EOI, but this provides a little bit more information. So now let's get into the nitty-gritty of how to actually review an insurance binder and make sure that it has everything we need for our borrower's financing. What I typically do is I start at the top and work my way down. I review the agent information, making sure it's complete, and make sure that the insurance company name is there. So now let's get into the nitty-gritty of how to actually review a binder and make sure it has everything we need for our borrower's financing. What I typically do is I start at the top and work my way down. I review the agent information, making sure it's complete and that the insurance company name is on there. I check the effective policy dates and make sure they're in the time frame of our closing. I confirm the insured's name matches the title documentation. I determine if the mailing address makes sense. If this is a purchase, I need to ensure that the current address is accurate and the new property address or the description of the property matches the subject property in our transaction. If this is a refinance of our primary residence, we need to make sure that the property address matches the description address. If this is a refinance of an investment property, we need to make sure that the insured's property address matches their current home and that the description box has the subject property, the investment property. Next, we need to make sure that the mortgagee clause is spelled correctly and has the correct address for the mortgage company. We need to check the loan number, make sure it's correct. Check the policy dates in the remarks section and make sure it is good for 1 full year. We need to check the premium amount, make sure it's listed on here, and also see in the remarks section if it's paid in full or if an invoice is required for due at closing. Next, we want to check to make sure that the policy has enough coverage to cover our loan that we're financing. Let's, for example, use a loan amount of $500,000. We need to make sure that we have enough coverage for this policy to cover the $500,000. If you see that the listed dwelling coverage is not enough, you will want to look for the replacement cost coverage and see what they have listed as the percentage amount. If it is not listed on the binder, you will need to reach out to the agent to ask them to put this on the document. If it is listed, you will need to determine if there is enough coverage or if you will need additional coverage. Here is an example for you. The loan amount is $500,000. The dwelling coverage is $350,000. That doesn't cover the loan amount, so we then look to see what the extended replacement cost coverage is. In this example, it's going to be 25%. You want to take $350,000, multiply that by the 25% additional coverage, and that's going to give you $87,500 in the extended replacement cost coverage. If you add that to the dwelling coverage of $350,000, you're going to see our new coverage is $437,500. If the dwelling coverage is still not enough to cover the minimum requirements for our financing, you will need to call the insurance agent and request an RCE, or otherwise known as a replacement cost estimator. However, please make sure you know the laws in your state. There are several states that you cannot ask for an RCE, such as Massachusetts and Florida. A borrower can request it, but not a lender, processor, loan officer, or even broker owner. For these states, the agent normally provides a letter for you to give to the lender. Now let's review a certificate of liability insurance, otherwise known as a master binder or master certificate. You're going to start by reviewing the same things that you did on the insurance binder previously. Start at the top of the form and make sure all the information is completed. On this form, the insured's name is not going to be our borrower. It is going to be the condo association or the management company, as this policy will cover the entire condominium. The next thing you should look for is to see if they have an all-in or walls-in coverage policy. All-in or walls-in means that it covers from the walls inside the property as well as outside. In order not to be required to have an HO6 policy, you will need to make sure that it has an all-in coverage. You need to make sure it has betterment and improvements and inflation guard. Betterments and improvement coverage is to cover the contents of the building. Inflation guard coverage is the automatic annual increase in the property value on the policy to keep up with the rising cost of construction. If it is not on the master binder, you will need to reach out to the agent and confirm if it's excluded from the policy or not required in that state. If it is excluded or not required, you will need to have the agent state this either in the remarks section, on company letterhead, or in an email that you can print for the file. I hope that you've enjoyed the very first how-to lesson in the series. I will be doing several more, such as how to review asset statements, credit reports, gift documents, and several more. Keep an eye out for them, and have an amazing day.